The parity trade is more of a manual process. I mentioned that you can compare parity trades, but there's not a button run that says you can compare parity trades. What I mean by that is if I was doing a covered call or a naked put, let's do a covered call search. All right, let's just take Lucid. Why not? And I'm going to go to the profit and loss chart. So here we can buy Lucid at 16.18. We can sell the September 23rd 1550 strike for 108. This would give us a max return of 2.6%. We're slightly in the money, of course, or $40 maximum profit. What's the parity to this run? This is an in-the-money covered call, so an out-of-the-money naked put with the same strike price, of course, and the same expiration date would be the parity trade. So I'll just clear these two out. I know I'm looking at $40 here and a 2.6% max return if I'm assigned at 1550. We'll go into view options. September 23rd, 1550 put. Yeah, and it's about the same, isn't it? So it's going to say 40.50 at midpoint, but 39 to 42, probably just going to get 40. I'm not going to get that 405. Maybe I will. Okay, it might be a little bit higher, but again, 40 to 40, there's no real difference in this case. This is a true even parity trade right now at midpoint. Whether I did the out of the money cash secured naked put or cash secured put or naked put, whatever phrase you want to term, or the in the money covered call. I'd have the same max profit of $40 provided the stock stayed above 1550. And of course, the max yield, naked yield here of 2.6%, or the max return if assigned on the covered call of 2.6%. Now, if I was doing bull put credit spreads, which I probably wouldn't be doing right now in this market with things we know that are coming up next week. Sorry, folks, I was trying to avoid that one. Let's take Broadcom. And let's go to the profit and loss chart. 21st of October is pretty far out. No, I was on a monthly. I wasn't on the weekly. I'm sorry. So a bull put credit spread selling the out of the money 470 put for standard expiration 21 October and buying the 460 put is going to give us a net credit of $235 on a 10-point spread. So we're looking at about a 30.7% return. In other words, the true loss on the position would only be $765. If the stock went down below both strike prices, we're taking in a $235 net credit. What is the parity trade to this? And again, these two bid asks, this one's a little bit wider than I'd like, 70 cents, but it's not too bad. But again, this one here, 8 for a 460 strike put, 8 to 860 is not too bad at all. What's my parity of a bull put credit run? A bull call debit with the same strikes and the same expirations. So, October 21st, selling the 470 call, buying the 460. Midpoints are actually pretty good. Only 90 cents for the in-the-money call, roughly about the same for the 470. So we're going to sell the 470, buy the 460. Bull call debit spread. And a little bit slightly less return in this case. 29.9 versus what we saw 30.7 at midpoint. So in this case, I'd be more tempted to use the bull put credit spread. Now, by the way, I just showed you one way to do it manually. For those strategies I just mentioned, there's an easier step to do it. If I was interested in our first position, Lucid, I just go to the option chain. Now, our option chain, I'm sorry. The option chain here, I don't have it selected, but what we show on the option chain for the call chain or the put chain is that you can select to view, let's see, the percent if assigned. I'm looking for the regular percent if assigned. I'm sorry, hold on. I don't want the simple. All right, so the downside protection I want. Maybe I already have it. I'm sorry. Oh, I apologize. Ladies and gentlemen, I apologize. Let's start on the call side, shall we? All right. Okay, so what I want here, I want percent if assigned midpoint and downside protection. And over here on the put side, I want naked yield, and I could put naked yield annualized. What I'd also want, if it's here, and I thought it was higher. Oh, there it is, percent to break even. All right, let's go ahead and submit that. So on the chain now, any stock that I look up, let's go to our 14 days out to September 30th, Ron. So on the call and put chain, now that I've customized it, I usually have them closer together, of course, but if I entered this as a covered call, any of these as a covered call, I'm now seeing my downside protection and percent return if assigned compared to the naked yield of selling the put and the percent to break even, which is about the same. In this case, the yield on the put, again at midpoint, is just slightly lower than the yield on the covered call, but it has a better percent to break even. So that might help you. I mean, it's only off by 0.1%. They're essentially even, Ron. But this gives you a gauge of the comparison of which one might best suit your needs. Where's our 1550 or 15? We get a 10% downside protection on the covered call with a 3% return if assigned and 10.1 and 3.1% if we do the naked put positions. This is not a recommendation to do a covered call or a naked put on Lucid, by the way. We're just showing this as an example. So on the chain, that's your quickest way to eyeball, not graphically, but to eyeball the numbers for the parity, comparing the percent naked yield on the put and the percent to break even versus the percent if assigned of a covered call, downside protection of the covered call position right on the chain. For those of you who are trading spread positions, we have that tool which you can identify under any of the vertical spread positions, bull put, bear call credit, bull call debit, for example. But there is the spread chain tool. This is also available under the signature tools tab. And the spread chain tool for the vertical spreads, you've got a credit spread view where I've put in some basic information here, minimum 55-cent net credit, 1% out of the money, minimum return of 10%, probability of 82%. And it's showing me the bull put credit spread on this side and the bear call credit spread that match that criteria on the other side. But you see here, there's 4 tabs. I could look at just the debit spreads, or I could look at the put credit, the bull put credit, and the bull call debit parity view. And let's go back to a 5-point spread here. Let's submit that. And there we go. And so right away here, I can see that the strikes 265, 270 bull spread with an 84.5% probability, the bull put would be giving me a 16% return if assigned. I'm sorry, if it expired, Ron. And I'd see a 17% return on the bull call debit if I could get filled at the midpoint. So let's say I'm bullish on QQQ. Not a recommendation or suggestion. There's a lot going on in the markets. We know that. But I usually do bull put credit spreads, which I do when the market timing is right. So what I would do, Ron, is when I decided which spread I want, I go take a look at the spread chain. And if I can get a reasonably higher position here, and I look at the info and I see that the bid-ask spread is not too bad, and I'm confident that I can get close to this midpoint on the in-the-money debit spread, and the increase in return is sizable compared to the bull put, I might go with that bull call debit. If it doesn't fill it first, then I'll come back and just do the bull put credit spread. Okay, just like we talked about a little while ago on the conversions. But this allows you to compare the parity for vertical spreads right on the same screen. And you have the call credit and put debit parity trade as well. A comment came in real quick. Do you have a parity for Condors? No, but again, you could follow the same process that we did manually. I know it's a little bit of a pain. But I'm sorry, let me go to other strategies. What I mean by that is that if I go into Iron Condor, great. What is an Iron Condor? Well, it's a combination of a bull put credit spread out of the money and a bear call credit spread on the same stock. So instead of being directional, you're trying to be completely neutral as possible. I'm just going to go with our initial values default. This was a search we did during a webinar, and I don't like those results. There's not enough volume or activity there. I didn't like those positions. Great. Okay, so let's just take Snowflake. And just as we did manually at the beginning, I'll go to the profit and loss chart. So I've got my bull put, and I've got my bear call 250 to 255. Stock's at 184.76. It's kind of skewed a little bit. We're about 40 points out of the money for the put and about 765 points out of the money for the call. So we're not exactly at midpoint, but we're close, or in the mid-range there directly between the stock prices. So what would a parity be to an iron condor? Well, it's going to be the all call condor with the same strikes and same expiration, or the all put condor with the same strikes and same expiration. So I just have to do the parity of the reverse, right? What do I mean by parity of the reverse? Let's say I wanted to check the all call compared. Now here on our iron condor, we've got a net credit of 87.50 for a return of 21.2% and a max risk or total requirement of 412.50. What's the parity to the bull put? It's a bull call. So what do I do here? There we go. I'm going to take out the puts, my 145, 140. Go to October 21st. And we're going to do the 145, 140. Sell the 145, buy the 140. Yes, that's a debit spread. So instead of the bull put, we're doing a bull call debit with a bear call, an all call condor. And now it's a bid-ask spread took a chunk, didn't it? Now it's only a return of 10.5%, max risk of 405, max profit of 95 instead of 87.50. Something's not. Oh, okay. The return was skewed a little bit. I see that now. This is saying that it's true. Yeah, my apologies, ladies and gentlemen. We have a cost now of the debit, but we also still have to cover the credit of the bear call here. In that case, that's why the total requirement went up to 905, and this got cut in half. But instead of making 87.50, we could make 95, but we'd have to put up the credit. I forgot to mention that. Sorry, guys. On Power Options, we know that if you do an iron condor, your broker will only require you to cover one side of the trade or the other. When I do an all call condor, I have my full debit here that I paid, which was, whatever it was, minus the net credit here, 20 cents. So I probably would have paid $4.25 debit for that spread, but I still have to cover the $5 requirement here for the bear call. Okay, they're going to require that as well, I think. Yes, they're going to require that as well. So that's just sort of the idea. The profit and loss chart is very similar, but this, sorry about that, does show a higher profit of 95. So again, if I'm confident that I can get these midpoint prices or close to them, where the iron condor was offering an 87-cent net credit, this is offering a max profit of 95. If everything works out the way I want, I might lean more towards the call. And if I wanted to see the put, I just would have left the bull put there and then changed the bear call credit spread to a bear put debit spread, and I'd be able to see that condor, the put condor as well. So Ron, those are just some of the ways, 4 or 5 strategies, how we compare the parity trade. There's not one link button other than in the spread chain tool, which I find extraordinarily useful. I also find the spread chain extraordinarily useful for creating iron condors, as I just mentioned. How would we do that? Well, if I go to the spread chain, of course, if I go into credit spreads, which we were before, and I want a minimum net credit of 35 cents here, and I want to be at least an 85% probability on both sides, the bear call and the bull put. That didn't work. Should have left it where I had it. Anyway, there we go. So if I was looking at an 82% probability for this particular expiration on October 3rd, the only strikes that really appear for me are the 313, 308 bear call with QQQ at 298 and the 270, 265 bull put. That's sort of my iron condor view. I know it's a little bit reversed because the puts are on the right and the calls are on the left. You might want to think about it the other way. But in any case, that's how we've got here with this structure. Another way you can use the spread chain tool there for iron condors as well. And the parity view, remember, if you're looking at covered call versus naked put, just use the chain. Select the percent naked yield. Sorry, let's just go to the chain real quick. All right. So remember though, select your call and put chain and do downside protection, percent if assigned midpoint. This is for if you entered it as a covered call today, and then the percent naked yield, the percent to break even. That gives you sort of the numerical side-by-side comparison of a parity view in the money covered call versus out of the money naked put. And then if you're doing spread trades, you can use the spread chain tool and the parity view on the spread chain tool as we showed. There we go. The put credit and call debit parity, or call credit and put debit parity as well.